Welcome to the latest episode of Renovating Retirement with Charlie Jewett and Bobby Alford. This show confronts the retirement planning industry and reveals all of the tricks, lies, and scams the stockbrokers, insurance agents, and financial advisors use to steal money from consumers. In addition, Charlie and Bobby will teach you everything you need to know to make your own financial and retirement decisions and live the retirement of your dreams. Now here are your hosts, Charlie and Bobby.
All right, everybody, welcome back to Renovating Retirement, 10 Reasons Not to Buy an Indexed Universal Life Policy or an IUL. This is part 2, and we are going through the Truth Concepts, almost exactly 10-year-old article. It was written in April of 2012, and we are filming this in April of 2022, so almost to the day, which is amazing. And if you missed our first episode, we covered reasons number 10 and number 9. And we'll go through in this episode and we'll review all 10 and then we'll dive into the specific ones. But as a quick recap, Charlie and I are shooting this from separate vacations we are on, which is why we love this industry. We are shooting this from separate vacations and enjoying our time right now. And Charlie's about to have a pretty big birthday coming up. So by the time you listen to this, his birthday may be past. But if you see it, drop it in the comments or whatever. Say happy birthday, Charlie. The big 5-0.
Yep, we were just talking about police officers. I didn't realize I'm 5-0.
5-0.
Actually, you're in Hawaii, so I'm Hawaii 5-0.
Oh,
almost.
my goodness. Man, I love your use of language.
Almost, yeah.
That's right. I'm Hawaii, you're 5-0. It's perfect.
That's what's up. What a team.
So we are shedding light on truth here, and you got the Hawaii 5-0 episode right now. So I'm going to share my screen. We're going to talk through the article. We're going to recap the top 10, and then we're going to dive into what we're going to address on this episode, which I believe is points 7 and 8. So let's go back up. Here's the if you're watching the video, the article is top 10 reasons not to buy equity indexed universal life. And we will see these 10 reasons. Number 10, internal costs not guaranteed. Number 9, mortality charges not guaranteed, which we covered in the last episode. Number 8, market drops cause double pain. And number 7, late premiums kill any guarantees. Number 6, dividends from index don't get credited, with a big asterisk there. Participation ratios are often less than 100%, asterisk. Returns are usually capped at various interest rates. Guarantees are not calculated annually. All of the above can be changed by the company. And the risk is shifted back to the insured. So, and this list right now, we're going to cover number 8, which was, how did he word it? Market drops cause double pain. Double pain.
One of the reasons I knew when I first read this article that there would be problems is because, I've been in the industry for a really long time, playing at a very high level. I'm a thought leader, and when I read his points, I don't know what they mean until I go read the paragraph. I don't even know what he's talking about, and then I see what he's saying, and I'm like, well, I don't agree with that. So, yeah, read this.
All right, so market drops affect the side fund negatively no matter what the side fund is invested in. Since the death benefit is comprised of the 1 year, parentheses, or annually increasing, close parentheses, term insurance, plus the side fund, any market drop causes double pain. Markets can drop regardless of whether they are supported by stocks or money markets, whether the side fund is reduced by a drop in the market or current interest rates. It now has less value, so more term insurance must be bought to make up the difference, which further reduces the side fund. Consequently, you have double pain, less cash value, and higher costs. All right.
Still don't know what he means. I still don't know what he means. Do you?
Yeah.
So I'm like, I understand these products very, very well. Tell me what you think he means.
So one thing we talk about with the Ken Fisher article, why I hate annuities and you should too. This article does the same thing. It conflates all the bad parts of all the different vehicles that have the term universal life in them. And so you're not going to have a side fund without a variable universal life product. So it's equity indexed, which is, he says in the title. By the way, if you're listening, I used air quotes.
I was going to say, isn't it in the title? Doesn't it say equity indexed?
Yes. But he used the term equity more frequently than he used the term indexed. So we are huge fans of indexed products. Indexed in layman's terms is most of the ups of the market with none of the downs. Equity universal life, you can think of that as variable universal life. And variable we do not like. It has tons and tons of fees that are buried in there, just like a variable annuity, tons and tons of fees buried in there. And there is no side fund without a variable universal life policy, just like a variable annuity. So what he is saying, and this is what I hear when I read that, is that the variable part of it, the side fund, is going to be invested in the market. If the market goes down, you are subject to all the ups and all the downs of the market within a variable universal life product, which is why we don't like them. And when the market goes down, your cash value goes down. And when the cash value goes down, there is more insurance to be bought because, as we talked about in the last episode, the corridor of insurance. To me, this is a linguistic magic trick that he's trying to pull off here. He's trying to make all these things work together. And in reality, we all dislike variable universal life. But you can't lead with it's an indexed product and then conflate the tools and parts of the variable that we don't like. That's what I hear when I read that. Does that sound right to you?
I think it's even worse. Something they don't teach you on the test and you'd never know unless you started the industry, 10, 15 years ago, is all indexed annuities and indexed universal life products were called equity indexed annuities and equity indexed universal life insurance. And the term equity doesn't even mean variable. So there's variable universal life, and then there's indexed universal life, which used to be called equity indexed universal life because I believe they were trying to reference the fact that it's linked to an equity index like S&P 500 or something like that. The problem, the reason I say it's even darker, Bobby, is in the title he says reason not to buy equity indexed universal life insurance, and then he's talking about variable universal life insurance, I think, unless he means this. Can the side account go down in a product where you don't lose money when the market goes down? When the market goes down, you don't make a penny, but you don't lose any money. But the cost of insurance comes out of that account that didn't make money. So the account's at $100,000, doesn't make any money, stays at $100,000, and then the cost of insurance comes out. Let's say it drops to $99,000 or whatever. Can that go down a little? The answer is yes. So this would be a crazy exaggeration and a poor choice of language because it certainly sounds like he's talking about a variable account side fund, right? Mm-hmm. The problem is if you look at the history of investment products or investment management, stocks, bonds, and mutual funds, they all go down. And we talk about over time, does it work out or does it not work out? So looking at any 1 year in anything is not an appropriate thing to do. Like, oh, this can't be a negative that, hey, it can't. Matter of fact, we literally have this saying. You and I fight it all the time because it hasn't been true for 22 years now. More risk equals more reward. What is risk? Losses. You can't say losses are bad. So even if this were true, you still can't say this is bad or a reason not to buy it. You'd have to say, does it work out? Like to have that loss, does it work out in the long run when you recover? Here's what's interesting. I don't think it's true. It's certainly not a strong argument. I think it's actually about variable universal life insurance. It's not really accurate for indexed universal life insurance. It might go down a tiny bit, just the cost of insurance in the years, but your account's almost the same size, and then the market resets at the lower amount, and they reset your annual point to point where your chances for making money jump up significantly. We have no recovery periods or anything like that. So this is a weird thing. Again, the whole article is just weird to me. It's a weird thing to say. I don't really know what he means.
I had a college professor when we were studying English, and the college professor said, look, we can analyze what this writer wrote, and in particular we were talking, I think, Shakespeare, which is, leaves a lot to interpretation, but he said, look, we can analyze what this writer wrote and think maybe he meant this, maybe he meant that, or we can say he missed this thing, he was really trying to say this. Or we can approach it as if the writer was a genius and every word was chosen for a reason. And he said in this class, we're going to assume the latter. We're going to assume that every word was chosen for a reason. And then with that, we will then interpret what the reason was and how that works. So that being said, I look at this article and I think you don't use the term side fund unless you're trying to talk about variable universal life. And you don't talk through the specifics, the negatives, unless you're trying to sell something else. And you are in a very small window saying, in this one particular instance, in this one caveat, if the cost of it, like you said, you gave them the benefit of the doubt, right? If you get the floor of zero, and then cost of insurance comes out, then, oh my God, it's the worst thing ever. Well, as you just clearly and very easily pointed out, once that annual reset happens, now I get to recover. And all of our clients right now are waiting for the market to reset, because when that comes down, those recovery years are amazing for IUL products. And so you very easily talk through the next step. But if you're looking at a very minute window, yeah, you can make an argument that costs are this and this is bad and so on and so forth. But you can do that for anything in the world. And to not give it the full breadth of information is, to me, that's where you can see their true intentions. And that's where, like you said, you reached out to Todd. He didn't want to have a conversation with you, and because ultimately there's no advantage in it to him to have that conversation. They've got their clientele and they've got their information and their Kool-Aid, if you will, that we all drank when we learned about the infinite banking concept. And now as I've expanded my horizons talking with you, I start to see that there's more out there to the industry, and shame on people who don't open their eyes to that conversation.
And here's the two words that become very important when you listen to the podcast going back 5 years. We never know. Was it ignorance or was it immorality? It doesn't matter. Like, were these incorrect words written to try to hurt people? Does he know they're wrong and he wants to steer you to whole life? That would be immorality, willful injustice or whatever, or did he not do his research and he's talking about universal life as if he knows, but he didn't do his research, so he doesn't know? It doesn't matter. Truth, like non-truth will hurt you. It's just not true. You don't have a side fund that drops significantly in equity indexed universal life insurance, which we call indexed universal life insurance. The whole point of indexed is that it doesn't drop when the market goes down. The words aren't true, Bobby.
That's it. All right, we're going to move on to the next point, and it'll be our last point for this episode, because the next three are going to be rapid fire grouped together. But this next point is late premiums kill any guarantees. So what was actually written here was, any late premiums remove any guarantees in the policy. In most universal life policies, even if the premium is finally paid, once it is late, the insurance company is off the hook for supporting any guaranteed premiums, cash value amounts, or death benefits. In many cases, the insured may not even know that a premium was late and that the guarantees have been forfeited. Thinking about the time frame of the 50-year policy paid monthly, 600 payments, ask yourself what the likelihood is of a mistake being made by the premium payer, their bank, the post office, the insurance company's clerks, or anyone else along the way. Wow. What I see when I read all of this is absolutely word for word how I would argue why you should not buy whole life. It has nothing to do with universal life, because this is exactly what happens when you miss premiums for whole life. They're the ones with guarantees that have the option to revoke them. They're the ones that make you make 600 payments. We build our policies, so we pay for only a handful of years. So this 600 payment 50-year thing, that is literally word for word a whole life conversation. And so when I read all of this, if you took out UL and you just put WL there for whole life instead of universal life, literally everything else I think applies to a whole life policy. which is why I find it hilarious.
The first place my brain went was like, I've never checked, but I'm curious on whole life what happens if you miss a payment, if it's something similar. But what's really strange about this is infinite banking and missed fortune from Douglas Andrews and tax-free retirement from Patrick Kelly and wealth on Wall Street, and everyone who talks about using life insurance as a tax-free, retirement supplemental income vehicle or cash accumulation vehicle talks about overfunding. We're not talking about buying life insurance with minimum premiums, whether you should do whole life or index universal life, no matter how they stack up against each other. We're always talking about the E.F. Hutton strategy from the late 70s, early 80s, putting in more money than you're supposed to, than you need to, overfunding or maximum funding, ideally. How could you ever miss a premium payment? There's always more money. Somebody has $100,000 and we're doing $20,000 a year for 5 years, which we call a 5-pay. And they put in $20,000 in the first year, and then we look at the minimum cost of insurance or what they'd have to pay, and it's $3,000 or whatever. They've got, what is that? They have like 7 years of premium in there, 6 or 7 years of premium there. Who's missing premium payments? Like, who does this apply to? Like, I just don't understand how this article was written. Like, let's come up with 10 reasons that apply to absolutely nothing or any of the ways that his competitors, us, the way we're actually using. Matter of fact, Bobby, you're from the infinite banking world with Nelson Nash. They're talking about overfunding too. So does Pamela Yellen.
Yep.
Bank on yourself. What does this have to do with anything? This is like pulling out of the world of overfunding and saying, well, if you bought a policy the wrong way and you made the minimum payments and you just bought it as life insurance, not as an infinite. What kind of infinite banking are you going to do? How much cash accumulation, Bobby, is there going to be in a policy where if you miss one payment, your premiums are late?
Yeah.
You have no money in there at all earning interest.
You're almost talking about a term policy at that point. Like that's really what they're talking about.
It's like a permanent term policy.
Yeah. And
that's not infinite banking.
No.
It's not infinite banking. You have to understand from a guy from the infinite banking world, he's saying top 10 reasons you shouldn't buy index universal life insurance for the infinite banking concept. You should buy whole life, which is really the sentence, right?
Yep.
And okay, has he ever sold a policy to somebody and told them you're going to be able to borrow against it to buy cars instead of doing car loans? You're going to be able to use it for infinite banking by paying the minimums monthly to so low that if you miss one, you actually are late and lose all your guarantees? Does he have customers actually doing that? So what does this have to do with buying universal life insurance instead of whole life when no one would buy either one of these products this way? Because you can't do infinite banking unless there's more cash than the premiums. Therefore, your cash value goes up and therefore you can borrow against it.
No, I mean, that's a great point. And you're exactly right. He would not, I mean, I don't want to speak for him, but he would not build this for his clients. If he's doing infinite banking, he would not build it this way. Neither would we. When I learned about Index Universal Life and I applied the infinite banking information and everything that I had learned, it performed better as an infinite banking tool. And so the
right.
commonality between them both is that you must overfund, decrease the amount of insurance, overfund the premiums, so you create that asset value, right? That cash pool that you can loan from, build into, so on and so forth. And none of that applies if you're paying so little over 50 years that a single mistake is going to make the policy crap itself. And that would be something that neither us nor him would most likely ever put in place. I know we wouldn't. I would say most likely he wouldn't either.
There's only two features inside of any investment tool: the costs that are sucking money away from you and the rate of return that's compounding your interest or growing your account. Whole life has higher fees and lower rate of return. Index Universal Life, properly structured, has lower fees and higher rate of return. There are 0 human beings on the planet, Bobby, that can argue illustration to illustration or truth to truth side by side that there's any reason for anyone to ever buy a whole life policy. So what they do is they hide, and they have a really, really good story. If I was the one hiding, if another famous person approached me and said, hey, you said something I don't think is true and I have evidence, can you come on and talk about it? I would say 100% yes, because if you show me I was wrong and you have something to help my audience, I'm going to thank you and bring you on my show and tell them. Hiding from this conversation says so much, Bobby. I'm just reading this article and it's all air. It's a big blob of fluff that means nothing so far. Like, I could argue more about a painting, which doesn't even have math involved. You know what I mean? Like, what's this painting mean? I think it's a polar bear having an epileptic seizure in the snow. No, it's not. You know what I mean? I'd have more to say about a painting, which is completely subjective, than this article. I don't know what it means. It's just straw man.
And you're right. It is a straw man argument. And the point comes down to why wouldn't he get on your show? Why wouldn't they have that conversation? It comes down to me to incentives, right? If you have built an entire practice on this one product, and this one product may not be the best, and therefore you must go back to your clients and say, hey, I can optimize this, I can do this, we got to move products for you. Then the egg on your face, you're not out for the truth, you're out for the best business model for yourself. And that's where I say incentives diverge. Now, I could be totally wrong, and Todd could say, you know what, I just didn't understand, and I want to do that. But if that were the case, he would be willing to have a conversation. Yep, that's it.
That's what we're hoping. I want him to come on the show and say, like, I was confused.
Yep. Or he comes on and explains all the numbers that we have are wrong, and we learned something, and we're like, oh, man, here, thank you. Totally. We can go back and talk to our people.
That's what humility looks like. Yeah. That's what humility looks like. And loving people is saying, come on, show me. I just want the truth. I don't care about. The problem is, if you name your company Truth Concepts,
yep,
and you have anything ever that's not true, that's a problem.
And I'll bring this back to one quote before we wrap this one up. Greg Glassman, he's the founder of CrossFit. I used to be a CrossFit coach. He had this saying, he's like, I don't care, and I'll paraphrase it, but I don't care what you do. I want the results. I want my clients to get the best results. And he said, if I find out next year that some of the greatest athletes in the world are in their basement hula hooping, and that's all they're doing, you damn right I'm going to be having people hula hoop this very next year, because it's going to produce better results for them. And that, I think, applies directly to what you and I do on a day in and day out basis. We don't care what the tool is. We don't care how we structure it. We want the client to get the best results, and we want to remove all the fees we can to give them that. Whether it's hula hooping or doing thrusters, if you're a CrossFit person, you know what I'm talking about, and they suck. But whatever it is, as long as it gets you the results, now we're talking, right? And so in the next episodes, we're going to talk through a couple more chunks of this list, and we're going to have more detail to share. But ultimately, it's all about truth. And I know we don't have that website, but it's all about the real truth and what we have seen. Charlie's almost 20 years in this business, and Douglas Andrews almost 40 years, same stuff, same products. As it evolved, it has become game changers, and you move along with the times into better instruments. You don't hang your hat on something that is not performing for the client the best way possible and say, that's it, that's all we're going to do, and we're not going to talk about it, because that's not okay. All right. I'm Bobby Alford. This is Charlie Jewett. This is another episode of Renovating Retirement. We'll see you next time. Mahalo.
Thanks so much for listening to Renovating Retirement. We hope you enjoyed the episode. If you have time, please subscribe to the podcast and consider rating and reviewing the show. That will help others find us. And for show notes, resources mentioned, and to connect, head on over to renovatingretirement.com. Thanks again for listening, and we'll catch you next time on Renovating Retirement.